Hey everyone, welcome back. I'm Tim and this is my channel. Boxed is a supermarket and bulky items delivery business who is set to go public via a SPAC merger with Sevenoaks Acquisition Corporation. Sevenoaks is currently listed on the NASDAQ exchange under ticker symbol SVOK. You can look them up if you want. The deal will value the combined company, well, really Boxed, Sevenoaks aren't bringing much to the table, but the combined company will be worth $900 million, giving Boxed a $337 million boost in cash to spend on whatever they want. We'll look at what they're going to spend it on and a little bit about the company because I didn't really know a whole lot about them before this video. I've spoken in previous videos how I think SPACs are becoming less and less of an attractive investment, and I think that's because there is just a record amount of SPACs out there at the moment and not that many private companies wanting to go public or ready to go public. So due to the nature of it, there's just too many SPACs, not enough private companies. They're going to start dredging up worse and worse companies. And I'm not trying to foreshadow anything about this particular company, Boxed, but I think it's important to keep in mind. Just think about it. It costs a lot of money to go public via an IPO. It requires a lot of scrutiny from the SEC, the public, and a lot of other organizations. And it ties up the top level execs for months on end. So with the rise of SPACs, wouldn't it be easier just to go public via a SPAC? Costs less, doesn't get the same level of scrutiny, and you can be public pretty quickly. It happens a lot quicker than an IPO, which essentially increases the chance of a less favorable company going public. With that said, I'm going to start with the most attractive parts of this company, Boxed. They cater to both B2C and B2B, which means they sell to both businesses and consumers. Often these two markets are negatively correlated, which provides good insulation if one sector goes into a downturn. Case in point being the pandemic. Well, the worst of it anyway. Their business sector fell by more than half, as we can see on the right side, while their consumer arm increased by almost half. This was caused by many of their business clients shutting down their doors, causing employees to work from home, far less orders, and also a lot of their clients in the business sector were airlines. So airlines didn't do so well, as you might know. So that is part of the reason, and obviously just in general, the pandemic affected businesses far more than consumers. Consumers were at home and a supermarket delivery service is exactly what they want. This is of huge importance. If their entire business model was focused on B2B, the pandemic would have taken a huge toll on Boxed, if not wiped them out entirely. They wouldn't be going public right now. So it's been a fantastic stepping stone having this B2C and B2B. But assuming businesses can stay open the next recession, will likely have the opposite effect. This is, of course, keeping in mind that groceries are a very essential part of our day-to-day lives, so Boxed won't be as affected compared to other industries. They have quite a high average order value, about double the rest of the grocery industry, which is really important when the main product you sell you also have to ship, so it increases their profit margin substantially. Boxed average order value across both their B2C and B2B arms is $100, while traditional grocery is just $45, you can see here on the right, and still significantly higher than other pure online providers. That should rise as they expand their B2B offering, with their average order value from their business customers at just below $200. So that's what's bringing that average up. If it was just the consumer arm, that would be a lot lower, that $100 number. On top of their core offering, they also drive revenue through ads, or SaaS, or software as a service as it's known. Their software sales will bring in $12 million this year, but they're wanting to expand that 10x to $106 million in about 6 years' time. Obviously, software has huge margins, so if they can execute on that target, then that would be huge. You can see here, 12 million to 106 million by the year 2026. Expected, of course, this is just projections. It could go horribly wrong. Now, they're expecting a lot of growth, which is certainly not a surprise. They're a startup and they're trying to expand their market share and all that sort of stuff, and it's great. But don't you think it's a little bit of a coincidence that the year that their industry, the home-delivered grocery, or home-delivered in general, anything home-delivered, explodes, that year they decide to go public? I think it's interesting that in this diagram here, they highlight how COVID had a huge impact on their business sector. That's why that went down. But over here in their consumer area, they don't really talk about how they expanded. I would suggest the jump from 109 to 158 is the result of more people staying at home and ordering online. In fact, it definitely is. That's how they grew. So the jump from 2019 to 2020 has come from the market expanding as a whole, more people ordering online, and I don't think we'll see the market or the industry expand at quite the same level again. Well, in fact, it won't. There is zero chance, pretty much, that the industry will ever expand like that ever again. I want to draw some diagrams here because this could be worrying, I guess. This is the home-delivered grocery sector as a whole. This is 2019. So in 2019, the entire home-delivered grocery sector was worth $35 billion. That's how much revenue came in. And from 2019 to 2020, the year of the pandemic, that grew quite substantially to $106 billion in 2020. Now that is a 3x, pretty much 3x the size. But in the same time, when the industry as a whole expanded by 3 times or 300%, Boxed only increased from 109 to 158 million. So they're a tiny little player in this whole game as well. So they expand by 40%. And the market, the industry, expanded by 300%. They're not new players to the game. They've been around since, I think, 2013. So they've been around a while. They should have been prepared for an expansion. If you're a startup and you can't expand with the market, then there's something really wrong. When the industry grows by 300% and you're only growing by 40%, then there's a problem. And then over the next 5 years, the industry as a whole is going to grow, well, projected to grow by just over double, maybe 2.5 times around, approximately. It's going to grow to $250 billion. And in that time, Boxed is expecting to grow 370%. So in the year when the industry as a whole expands by 300%, they can only grow 40%. In the year when in the 5 years after that, when the industry as a whole grows about 250%, they're expecting to grow 370% from 158 million. They're going to go to $748 million. Something doesn't add up here. The projections are off for me. If they can't at least keep up with the market in this year, 2020, when everything's exploding, how are they expected to outpace the market over the next 5 years when the market is still expanding, but by no means the same level as it did this previous year? Putting aside their growth projections, let's focus on a trend we're seeing among most of these delivery style operators. It's not profitable. The likes of Uber, Deliveroo, and Grab from Southeast Asia all had the advantage of solidifying their position at the top of their industry after being first movers, and even those companies aren't profitable. Now, granted, Boxed is in a slightly different industry, but I still think it's an important comparison to make. They currently hold 0.15% of the entire market share of this home-delivered grocery industry, which isn't exactly a commanding position to be in. And their main competitors, Amazon, Costco, and Walmart, all companies that would happily crush a small company like this that's only doing 150. It's worth less than $1 billion. To these companies, Amazon, Costco, and Walmart, that's nothing. They will happily crush them in a price war. The thing that makes these competitors even more difficult is they aren't slow-moving behemoths that have sort of passed their use-by date. These are companies that are all highly efficient, highly agile, and especially in Amazon's case, it's optimized for efficiency. I mean, they've got money to burn and throw at something like this because they are entering this space. They don't care if they knock a $1 billion company out of the way. What is $1 billion to Amazon? And some people may say, the only reason they're unprofitable is because they're investing everything into growth. And if they stop doing that, then they'd be profitable. Well, if we stripped away everything that could be perceived as reinvestment for growth, they'd still be making losses. For example, their 2020 gross profit, which is the difference between the cost of goods sold and their total revenue, was $26 million. And the cost of fulfillment and staff and overheads, that's the cost to provide their service, to provide their goods to sell. It's like, I'll put it this way, it's like I've got my iPad here and I can buy this iPad for $1,000, but it costs Apple $1,100 to produce. That is the position that Boxed is in at the moment. So even if they took away all their investment in growth, they'd still be making a loss on every single box they send out to consumers. I just can't see this company taking off. Sure, they might be able to carve out a nice niche for themselves, but in terms of gaining a solid market share, nah, probably never. The opportunities will come from expanding their high-margin white label products. That's the products they brand themselves. Increasing the percentage of sales coming from urban areas where shipping costs would be lower. That will increase their margins and economies of scale if everything's in a tighter area. Currently, only 9% of their customers live in urban areas, or urbanites as they call them. Expanding their B2B sector, their average order value in B2B is $200, so expanding that is going to increase their profit margins. And expand their SaaS sectors, or software as a service. Their main risks will come from overwhelming competition from Amazon, Costco, and Walmart, and their internal ability to actually be able to deliver a profit. They're a while away from it yet. My latest concern is, of course, their valuation. Now, they're valuing their company at a 2.1 multiple of their fiscal year 2022 revenue, so their expected revenue, and as we talked about before, they're not keeping up with the industry in their growth, so their future growth projections, I think, are quite bullish, and they're basing their valuation off their 2022 revenue, which they expect to have increased by almost 60% as opposed to fiscal year 20, which has just been. That does mean they'll be sustaining a very high level of growth these next few years to meet that target. I just don't think it will be possible, but the earnings multiple is generous enough compared to other industries in the same sort of sector, so there may be a little bit of slack. I'll bring up a comparison here. This is their comparison with other companies in the same industry. So Boxed is down here in their 2021 expected revenue. So for every dollar of expected revenue in 2021, their valuation will be $3, and then you compare that to the other companies in the same industry, and you see they're on the lower end of most of their areas that they're in, although hard to compare it because they're not really the same industries. I mean, these guys over here, they can't really be comparing themselves to Shopify. It's pretty hard to do a comparison. So maybe there's a little bit of slack. They do have a 2.1x multiple on their earnings. So yes, there's a little bit of room for movement, but their earnings are definitely too high for me. But the fact is, if you can't capitalize off a booming industry like it was in the middle of the pandemics, then it's going to be pretty tough when the industry matures. Box has a pumped up valuation due to the pandemic, and they're going to struggle to sustain growth in a mature market. This company is red hot, so don't touch it. If you like this type of content, please do consider subscribing. I post finance-related videos like this every week, so I'll see you back here next time.